What's up everyone, it's Karthik with MoneyVest. So in this video, wanted to go over the Federal Reserve's meeting for next week that's going to take place on July 31st. So I wanted to break down everything you need to know prior to the meeting here, as well as the unemployment numbers that are going to be coming out next week on the first Friday of the month. Again, I do apologize. I am very much under the weather. Once again, I woke up this morning. The fever is gone, so that's good, but I'm still having to deal with some severe headache and some cough. And my entire body just seems to be really weak. So I'm still trying to get back to, of course, being normal. But yeah. So but still, this is important because as we know that next week is going to be quite crazy with all the earnings and of course the Federal Reserve's meeting as well. So hope you all enjoyed this video and find it helpful. I may cough in the middle of the video at some point. I'll cut those pieces out, but yeah, hope you guys enjoy it, find it helpful. Make sure that you drop a like and subscribe to the channel. Also, I've opened up a few more spots if you are interested in joining our Patreon, getting access to all the members only videos, and also getting access to the MoneyVest platform. There's going to be a lot of Discord channels, including trade alerts and ideas. So link's going to be down below. You can join before the end of this month and take advantage of that discount as well. So this right here is the Federal Reserve's calendar, and you'll notice that July 30th to 31st is when the next meeting takes place. We don't have the summary of economic projections coming out, so this meeting is going to be without an SEP. The next SEP comes out on September 17th and 18th. 18th is when it's going to be released with the projections for four things: inflation, interest rates, unemployment, and economic growth. So if you go over to the last SEP, which was released back in June. This right here was the summary of economic projections from back in June 2024. Scroll down a little bit. I think the biggest concern that we witnessed from the previous meeting, which I also discussed in our last month's live stream, was that the federal funds rate, the projections have increased for 2024. So what that means is that right now we're sitting at 5.25 and 5.5%. That's the current interest rate from the Federal Reserve. Now they increased their projections from 4.6 to 5.1%. What does that mean? That essentially only means one rate cut, right? One rate cut is what the Federal Reserve is now penciling in on their summary of economic projections, whereas in the past they have told us 4.6, that is about two rate cuts, to as many as three rate cuts is what the Federal Reserve was pricing in. They've also upgraded their inflation expectations from 2.6 to 2.8%. We also did get the inflation numbers, the PCE numbers on Friday, which were again slightly higher than what the expectations were. And again, PCE on a year-over-year basis was on par with the consensus. But this again was a huge change from the Federal Reserve's expectation for interest rate cuts. If you come over to what the market's pricing in, the market's still very optimistic for at least three rate cuts in 2024. So they're expecting for rates to come down from 5.25% down to as much as 4.5% to 4.75% by December 2024. And that's three rate cuts getting priced in. And then eventually, overall, six rate cuts between now and the next July for us to come down to 3.75 to as much as 4% for interest rate cuts. Now, as we already know, that Jerome Powell has been very vocal about this idea that we still need to see more good inflation data in order for us to feel more confident that interest rates can get cut and inflation is sustainably moving down towards their 2% target. But I also wanted to take the time to go over this. And this right here is the FOMC voting members and their policy bias in 2024. So as you know that we do get a lot of members that rotate in and out of the FOMC members committee. And this right here is 2024 members. Of course, we've got Chairman Jerome Powell, we got Philip Jefferson, we got Michael Barr, Michelle Bowen, Christopher Waller, Lisa Cook, we got Adriana Kogler, John Williams, Loretta Mester, Thomas Barkin, Raphael Bostic, and Mary Daly. Now, these are the people that are voting members of the FOMC, and then we got non-voting districts. So these are all the people like Susan Collins, we got Patrick Harker, Lori Logan, Neil Kashkari, like all these people are non-voting members. So it's really just these people right here. So that's 7 plus 4, 11 members over here at the top, whose opinions and expectations and analysis really matters because they're the voting members of 2024 and they're the ones that are going to be tilting the scales towards for or against when it comes to interest rate cuts. And the little notation you see like N or H or D, that essentially means whether they are neutral, whether they are a dove, or whether they are a hawk when it comes to interest rate policy. So you can see that Jerome Powell is neutral. We already know what Jerome Powell has been talking about with regards to interest rate cuts. He's been talking about how they need to see more data, more good inflation data in order for inflation to sustainably move towards 2% before they can gain greater confidence so that they can cut interest rates. That's still in their plans, but they don't want to put down a timeline on when that's going to happen. But I wanted to go over some of the other members as well and what their opinions are, and more specifically, some of the more hawkish members here, like for example, Michelle Bowen, Christopher Waller, Loretta Mester, and Thomas Barkin. And I really only found one person who is still not expecting any type of interest rate cuts, and that is going to be Loretta Mester. So if you come down, I believe that is Loretta Mester. If you scroll down to Feds Bowen. So actually that's Feds Bowen, Michelle Bowen. Michelle Bowen right here is the only member in the FOMC so far that I've been able to see who is still not very open to the idea of interest rate cuts. As you can see that this right here was from back in June 25th, so not too long ago, so it's just about over a month ago. Feds Bowen says rate cut is not appropriate yet given inflation risks. So reading further, she says the Federal Reserve should not be considering cutting interest rates given the continued risk that inflation remains sticky or even more higher. And we are still not yet at the point where it's appropriate to lower policy rate, is what she said in a speech in London. So that, again, is one of the key members that continues to believe that we are not there yet. Inflation needs time to come down, and the interest rate cuts are not appropriate. If you scroll over to this, so this right here is going to be Loretta Mester, who was also a hawk, as you can see over here. She was also a Cleveland candidate, and she is also a hawk. But you'll notice that if you scroll down, Mester also indicated that long-run path is higher than policymakers had previously thought. Her fellow policymakers, San Francisco Fed President Mary Daly, also said Tuesday that she expects cut this year, but not until there's more convincing evidence that inflation has been subdued. And Loretta Mester said that she still expects interest rate cuts this year, but ruled out the next policy meeting in May. So this was a little bit outdated data. So this is from back in April, but the idea is that they're still open to the idea of interest rate cuts, but not as many as what the Federal Reserve guided us in back in March, and also clearly not as many as what the markets are pricing in for 2024, which is 3 rate cuts in 2024. So Mary Daly also in a similar boat as Loretta Mester. And if you take a look at Feds Barkin, he was probably another hawkish member in the FOMC. So Thomas Barkin from Richmond, also a hawk. If you read further, you'll notice that he wants to move deliberately on interest rates. And this right here, Richmond Federal Reserve President Thomas Barkin said he wanted to proceed deliberately on interest rates because it was uncertain how much the current level of interest rates was slowing the economy. In a talk to the Greater Prince George Business Roundtable, Barkin said he thought that there was still more downward pressure on demand in the pipeline because of the lags from prior interest rate cuts. So that is in a way indirectly suggesting that, okay, there's definitely going to be some slowdown in the economy. And I think it's really important for us to move a little bit more deliberately when it comes to cutting interest rates because of the slowdown in overall demand. They don't want to do that too much. But as I mentioned before, that the risk of doing too late is less than the risk of doing it too early. So the risk of doing too early is always going to be greater than the risk of doing too late when it comes to interest rate cuts. A reason being is because if you cut interest rates too soon, that is going to risk inflation accelerating back higher and going up, and for us to create another problem. Then as opposed to if you cut interest rates too late, then all you're really working for is getting unemployment back up. Because when the economy slows down, when the demand is starting to slow down and interest rates are higher for longer, that sooner or later affects unemployment, which we'll get to now because unemployment numbers are coming out next week here. So the first Friday of the month, we're going to get the unemployment numbers, and you're already starting to see some effects of how this is playing a role, because if you scroll to this number, so this was obviously in the sub 6 million, that's the unemployed persons, and now we're getting up to well over 6.8, almost 7 million people are now unemployed as of June of 2024. So if this number continues to accelerate, or worse, gets up to over 8 or 9 million people, the unemployment rate is going to shoot up to over 5.5 to as much as 6%. And at that point, the Federal Reserve will really have to make a choice whether they start lowering interest rates to help support the economy and unemployment, or they keep interest rates higher for longer to really rein in on inflation and help it bring downwards even further. Because as I said, they're going to be in a rock and a hard place if unemployment starts moving higher. They're really praying that by the time unemployment starts moving up, they've already gotten inflation under control. But if that doesn't happen, it's going to be a bit of a problem. And I really, really want everyone to really comment in the comment section below on where you believe that we will be. Excuse me. Where do you think that we'll be in this bullseye chart? So this is from Chicago Fed, and this is the dual mandate chart from the Federal Reserve. So I really want you to comment where exactly you believe that we're going to be in this dual mandate chart from the Federal Reserve. So what this is essentially is showing you where the Federal Reserve wants to be and where it currently is. So if I essentially go over this, so this is where the Federal Reserve wants to be, right? This is where inflation's controlled at 2%, unemployment is just over 4%. This is the target for the Federal Reserve. But right now, as you know, that we are at 4.1, but we are also much higher on core inflation. So we're all the way up here. The goal for the Federal Reserve is to move this dot from up here down to here. In other words, bringing inflation down while keeping unemployment stable and unchanged at close to 4%. So if that doesn't happen, right, the worst case scenario is for us to be in this quadrant. This right here is the worst quadrant to be in. Reason being is because at this level, you have both high levels of unemployment and high levels of inflation as well. This ideally would be the best quadrant to be in because here you've got very low levels of unemployment and you've got low levels of inflation, right? So this would ideally be the best quadrant to be in, but as you know, that we are all the way up here, and the worst place to move is going to be towards the right. We really want to move down and left instead of up and right, because that would be the worst place to be in if you are here inside this quadrant. So let me know in the comment section down below, what do you actually believe? What do you think as an analyst, as an investor? Where do you think we'll eventually be in this dual mandate bullseye quadrant? Wise 1, 2, 3, 4 in the top right or the bottom left or the bottom right or the top left. Let me know in the comment section down below. But I do believe that if interest rates don't come down sooner or later, because inflation is not, well, it is coming down, but it's not coming down at the same rate as it used to, right? A lot of it had to do with supply and demand with regards to supply chain. Yes, the Federal Reserve can control the demand by lowering or increasing interest rates to some extent, but at the end of the day, people are still going to spend money regardless. As we have already seen, the debt levels hitting new all-time highs, mortgage debt, credit card debt, auto loans, everything's been hitting new all-time highs. So people are still going to spend money regardless of where interest rates are. So in order to really bring inflation down, I do strongly believe the effect of higher interest rates on inflation is diminishing as time goes on, because people in general are really just not caring about whether interest rates are higher or lower. Yes, it's slowed down on the bigger asset purchases, like for example, buying a new car or buying a new home. That has been affected, but when it comes to day-to-day items, when it comes to essential items, I think that continues to be unchanged with regards to the demand, because that is still strong. I mean, that is represented in the earnings, that is represented in the credit card data, that is represented in overall retail sales. Just a lot of these metrics out there that are showing us that regardless of where interest rates are, people are still spending money. So I do believe that interest rates' effect on inflation is diminishing as time goes on. And for those reasons, I do believe that interest rates need to get cut in order for us to, well, not really maybe let's say 3 to 4 rate cuts, but 1 to 2 rate cuts in 2024 for us to then wait and see where inflation goes. And then that's also going to help support the economy, thereby making sure that we don't really increase in our unemployment rate. So next week, we're going to find out where the unemployment rate ends up being. But let me know in the comment section down below, what do you think about the overall FOMC situation? Next week is when we have the meeting, a very, very important meeting coming up by the FOMC, as well as the unemployment numbers scheduled for Friday as well. So hope you all enjoyed this video and a complete update on the FOMC here. Make sure that you drop a like and subscribe to the channel. Links to our Discord and Patreon is going to be down below. We'd love to have you on board. And as always, happy investing. I'll see you all in the next video.